global chief economist in charge of the strategic investment and innovation. I think you've been done lots of the trend research, have a huge impact on the market and the industry. And recently you published a new book. Just wonder what is the message you want to send to our audience, and what is the real implication given the recent uncertainty in the different scenario market.
Again, thank you for having me. And I'd say the book and the idea for it started over a decade ago, so 10 years ago, when myself and my team, we have over 100 research group organization. We started looking at how AI could potentially change our work, society, particularly with respect to technology. And as we started to incorporate how AI could shift the economic landscape, the market landscape, we assembled or collected the largest data set in the world on past and present technologies. And when we did that, I started to see potential implications that were materially different than the economic outlooks that I tended to see around the world, whether it was from the IMF, the World Bank, the central banks, the Federal Reserve, in China, in Europe, and it was eye-opening to me. And so it has changed how we think, what could happen over the next several years, and I felt it, and it also started to reveal some profound investment opportunities as well as risks. And so I felt compelled to bring that work at a high level to a wide audience, not necessarily just CIOs such as yourself and CEOs, business leaders, and to extend beyond the economist community. And so that was the genesis, the start of the book. And so what I'm most proud of is that we are taking. This is not my opinion of what may happen. I mean, I've been in the industry over 20 years. We are bringing data to bear to see what really could happen and to take it seriously. How AI may affect the world, along with other trends in the world, globalization, debt levels, demographic change, a lot of serious forces. And so we're proud of how the framework is guiding us, and it is really relevant today. I can't go a day without talking about artificial intelligence. I imagine you're the same way. So that was the genesis, but we are generating. The bottom line is that over the next 3 to 5 years, our diagnosis is that there is an 85% probability that every economic forecast in the world is wrong.
Right.
And that's a pretty profound statement. I was not looking for this diagnosis. It has changed our outlook, and I think over time it will change others as well.
You mean market is based on your analysis? Market is a huge underestimate the economy growth.
Yes.
In general, all right.
I think in the United it's nuanced. In the United States, the equity market the stock market has been exceptionally strong.
Yeah.
However, as you know, it's very concentrated. Particularly the gains have been in the past 3 or 5 years in very large cap technology oriented companies. You're starting to see that dynamic certainly in Asia as well. And these are very good companies. These are companies that are at the frontier of artificial intelligence.
Mm-hmm.
Um, However, our research found, and I did not know this, I've been in the business 20 years,
Mm-hmm.
is that during periods of profound technological change, there are two phases. So there's two phases to the investment cycle.
Mm-hmm.
And if AI is as transformative as we diagnose, the most likely outcome, phase one is where those technology giants, those technology leaders do
Mm-hmm.
fantastically. They do really well. You're building out the new technology. Earnings growth is exceptionally high. You see that in China. You see that in Asia. You see that in the United States. It's chips, it's data centers. But when we look at every other past technological cycle over 150 years, eventually you see a shift in those dynamics. And the gains of the market start to shift from the producers of the technology to more of the users
Yeah.
of the technology. And that was really fascinating to me because it makes those companies more productive. It makes them more efficient. It starts to create new industries. And I talk in the book about examples of past technologies. And so it's the second half of the technology cycle. We're still in the first phase, but eventually there's what I would call a great rotation. There's a
Mm-hmm.
rotation in gains to parts of the market that many are not talking about. And it's
Mm-hmm.
because of how technology transforms the entire global economy that leads to those gains in phase two.
I agree with you. I think you point out recently, the market still reflect the phase one, which is focused on the AI hardware, the infrastructure, everything, right? The tackle strategy. I think going forward, we expected looking forward more deeply phase two, which is application level, right? Can transfer from the hardware to the application level down to the all the ground, every level of the economy, every fields of the industry. I
And
agree with you.
we saw this in past technologies. Again, I didn't know this or appreciate it. I was having colleagues in the industry, my friends and family asking me, how do I invest, Joe, if AI is so going to be
Hmm.
so disruptive and transformative? And I literally thought, oh, I should just buy the tech companies that are producing the AI. Um, what I didn't appreciate is that in past cycles, those very industries that were disruptive in the past, electricity, personal computer, and hardware in the late 1990s,
Hmm.
um, um, car companies, auto manufacturers
Hmm.
in the 1910s and 1920s. You could use it today with electrical vehicles.
Hmm.
Um, they are disruptive. I'm not saying there's not profitability in some of those sectors, but what happens are two things at the same time. And one is already happening. And that is the, the disruptive technology has a wave of new companies come into this space.
Hmm.
So in the United States alone, there has been over 5,000 artificial intelligence companies created.
Hmm.
What happens over time is the price of AI technology tends to fall, but there's a lot of competition. It means like
Hmm.
it's more likely to be adopted and used, but the profitability of the sector per company goes down, and there's high failure rates. We saw this with automobiles. You saw it with electricity. Um, and secondly, at the same time, um, what it does, the technology disrupts its own industry the most.
Hmm.
So electricity completely changed the energy industry a century ago.
Yeah.
The profitability within the sector. In the 1990s, software companies ended up becoming the biggest beneficiary, yet it was hardware. It was the personal computer,
Hmm.
Intel chips, personal desktop computers that led
Right.
the transformation, but they were not the most profitable companies.
Mm-hmm.
In fact, new industries were things such as online shopping, like
Mm-hmm.
Amazon is the classic example. That was not a personal computer company. And so what we're seeing today, you're seeing the AI, the data centers, the chips initially going up. But you're seeing software as a service, those prices coming down.
Yeah.
It's exactly what happened in transportation. The
Mm-hmm.
automobile destroyed the profitability of
Mm-hmm.
railroads
Mm-hmm.
and trucking really disrupted the industry. So there's ways that we as investors can navigate this AI cycle. I'm not saying
Mm-hmm.
sell the AI producing companies, but it is unlikely that their recent gains are going to be the same gains and market leaders over the next 5 or 10 years. It would be historically unprecedented if that would happen.
All right. All right. Okay. So come back to your book. You mentioned about we're going to facing a tipping point in the next
Yeah.
decades, and
Yes.
the way we're living and to do the research,
Yeah.
investment, even we talking about how to interact with each other. So being the ordinary people, investor, how are we going to deal with the coming, the fascinating change,
Yeah.
all the underlying stuff?
Yeah. I think the first way we can all think about it is just us as workers. So if we have a job, um, how we have diagnosed or how we have thought about AI is that we're looking at the three dimensions of how technology changes our life, particularly through how we work. And there's three dimensions of how technology, transformative technologies, change how we work. One is it may save us time,
Mm-hmm.
so automation, right? That's the first dimension. The second dimension is what I call in the book augmentation. It's a complement to what we do. Think of the personal computer for my job. I could not have written this book without the personal computer
Mm-hmm.
and the ability to look at statistical patterns. And then the third dimension, which is really rare, but general purpose technologies have this dimension, electricity, railroad, and what we suspect AI, and that is it becomes a platform for new industries, new jobs,
Yeah.
completely new types of activities or tasks. Um, and so as we have our data and as we project and seeing all the investment decisions that CEOs around the world are making in real time, what we are showing is that, and you mentioned over the next decade, it's really the next 3 years that we are going
Mm-hmm.
to
Okay.
see a material change in
All
how
right.
we work, um, and how it affects. And we've looked at every single occupation in the world. We have looked at over 1 billion job descriptions,
Mm-hmm.
every single occupation in the world, and looked and have examined how AI on those three dimensions may
Mm-hmm.
affect our activity.
Mm-hmm.
And and the most likely outcome is that we will change how we do our job in the next 3 years. About twice the change will be twice as large as what the personal computer did
All
in the
right.
late 1990s. So it's going to be a big change for how we do our job.
Okay. So in summary, you think it's going to be changed much faster than everybody expected, right?
Yeah, yes. It's now
Okay.
there are some
Not the
technology.
decades, just 2 or 3 years, it's going to completely
Well,
change,
yeah, and
right?
again, in the
Everybody.
book, I'm trying to look out longer
All right.
term, when
Yeah.
everything's settled, where
But
we
in the
see
reality, it will be much quicker, right?
it
Yeah.
well, and when I showed the 10-year average, but what I don't talk about in the book, but I'm sharing with you, the biggest change is before the year 2030.
All
So
right.
the projections, it is twice as fast as the personal computer, and it's twice as large. So twice the amount of change in half the time.
Okay.
Um, and it's nuanced. For roughly 2 out of every 3 jobs, there will be automation, but there will also be complementarity. So in other words, there will be more jobs and the workers will benefit from this technology.
Mm.
However, there are occupations, roughly 1 in 5 jobs, that will start to see significant automation and to see job loss.
Mm.
And we have a pretty good handle or idea of what those occupations are. So there is disruption here, but that's the way we are generating higher than expected productivity and hence higher than expected GDP growth, higher GDP, even with flat demographics. In China, the demographics are going down. In the
Yeah,
United States, they're flat. But you
yeah.
can have higher than expected growth if you have workers that are more productive. And that's what we started to see 2 years ago. And we're
Okay.
starting to see others talk about that possibility, but that has already become every data point that we see is already tracking our most likely scenario.
Mm. So the AI does empower, the financial industry particularly. As you and me is in this industry, we can feel it. So, but on the flip side, I think people also worry about it, reading about the headline news, think it's going to replace lots of the older job, as you mentioned about the software companies, or the price is all the way down. So just wondering, what do you thought about that?
Well, and given how we look at the 3 dimensions of technology and how AI can change how we can automate and then complement the work, um, we know some industries will be disrupted more so than others.
Mm-hmm.
And what I've told audiences for actually roughly a decade is that the amount of time that you spend in your job, the percentage of the week that you spend in your job on the computer
Mm-hmm.
is roughly equivalent to
Mm-hmm.
the percentage of your time that will change in the next 3 years. So I spend roughly 70% of my time on my computer, doing work, writing reports, doing analysis. That 70% will change profoundly. And the 2 fields that we identified years ago that we're going to see the greatest automation rates were information technology or tech workers, as well as finance. They're highly empirical. A lot of the jobs are trying to discern patterns in the data, and that's precisely what AI is really good at.
Okay.
And now that does not mean that there's not going to be finance jobs. What it means is we are going to change the percentage of time at what we do our job. And we
Mm-hmm.
saw this with the personal computer, when it changed to accounting, when it changed
Okay.
to finance.
Mm.
Most jobs, your job, my job, at the end of the day, AI is going to automate roughly 30% of the job. But that means we can spend more time on the other 70%. And so net, it'll be generally beneficial. But
All
there
right.
are some occupations, I want to be clear, there are some occupations
Mm.
in finance, basic trading, financial trading, portfolio trading, basic analysis. Those jobs will be
All
automated
gone.
away
Yeah.
and will change. And we saw that with personal computer. I told all my children. My children
Mm.
are in college, university.
Okay.
I
Okay.
told them not to go into computer programming
All
for
right.
that.
Okay. Okay. So what are your thoughts on the inflation side? There's people talking about right now we're in the transaction period, right? When the new job arising, it still take time. So especially right now, I have the huge threat for the white collar class. And I think people talking about lots of the good stuff about the AI. But when we come back, whether or not the AI will bring the inflation or deflation, because
Yeah.
let's take U.S. for example. Two-thirds of the GDP contribution still come to the consumption, right? If
Yeah.
the temporarily, let's say in the next 1 or 2 years, the unemployment rate, according to Elon Musk said, maybe in a certain industry, we were facing a high unemployment rate, right? Which is mostly coming from the white collar class, white collar jobs. So do they have a negative impact on the inflation side? We will cause to the deflation problem. What do you think?
Well, and I think that's what Elon Musk is talking about is, in his view,
Yeah.
the automation dimension, the automation effect will be of AI will be so much larger than the complement.
Mm-hmm.
AI as a complement like the computer. And because automation will dominate the positive, you will get massive job losses,
Mm-hmm.
high unemployment, which ultimately would push down prices,
All
right?
right.
It's like a Great Depression, stagnation sort of world.
Mm-hmm.
That is a possibility. I talk about it in the book, but that's where our data and our framework is really powerful.
Mm-hmm.
What most are missing, and what respectfully Mr. Musk I think is missing, because we've looked at this for over 10 years.
Mm-hmm.
When we look at every job description, 3 jobs will benefit from AI for every
Mm-hmm.
job that is negatively impacted. Okay.
Okay.
Um, but we're not there yet because AI has to actually do more things to make us more productive. It's actually
Mm-hmm.
not advanced enough.
Okay.
Um, if AI would stall where it is now and it would just automate some of our jobs and not create new industries, then yes, we'll have AI just reducing jobs, not increasing other jobs. And
Mm-hmm.
then you get his world. And that is our other scenario, which is why we're getting non-consensus outcomes in the future.
All
That
right.
is ultimately a world where growth comes down in the United States. It would come down in China significantly.
Mm-hmm.
And then you would have debt issues. So
Mm-hmm.
debt burdens in the United States more so than I think China. But it would not be a great environment. It would be an environment where the stock market would have a lost decade because the earnings and the expectations for future growth would not be realized.
All right.
Effectively, that world, he is talking about the world where AI does not become a
Mm-hmm.
general purpose technology. It
Mm-hmm.
does not become electricity. So again, there's people that are mixing terms.
Yeah.
If and so what that world is, AI just become it's a repeat of the assembly line for office workers. So you're my job. We just we reduce time. We don't need 100 workers for our company. We need 30
That's right.
because we're doing the same work.
Yeah.
That, however, means AI has not become a general purpose technology, is not created
Mm-hmm.
new industries that could
Yeah.
offset somewhere else, new
Mm-hmm.
activities, new business, which is
Mm-hmm.
what the personal computer did and what electricity did. Electricity created the entertainment industry and movies and whole range of new industries. The combustion engine created airlines and air transportation and trucking and grocery stores across the world. So it led to a lot of other jobs, even if some jobs went down.
Mm-hmm.
And so there's more than an offset. But that you can see where our framework is really opening our eyes to there is no way we are getting the expectations of most economists and most experts, quite frankly, in the world. Elon Musk, his world is impossible. It's roughly a 30% chance.
Yeah.
The much more likely scenario, though, is what I call AI transforms. There is
Okay.
some job loss, but there is more jobs that benefit. And that's the world that is most likely right now. But we need to see AI advance along more dimensions. And we
Mm-hmm.
need to see it start creating new products and services. Right now, AI is only saving time, so it is not yet a general purpose technology.
That's right.
It's what we think it'll become, but it is not there yet.
Mm-hmm. Okay. I think I'm on your side. I'm with you, more optimistic about the AI development to the overall economy growth.
Yeah,
I think in your book, you're also talking about, they have the four Megatrend, right? AI, you're talking about the global def, the fiscal deficit and the deglobalization. And I think even the aging problem.
yeah,
I think take the U.S. for example. You shared that you have the three scenario to go, and if the AI succeed, the economy is booming, have half the probability,
yeah,
and the AI fails, the
yeah,
economy will into the bad shape with a 30 to 40 percentage, and the
yeah,
rest probably will stay where we are.
yeah.
And I think, what is your co-assumption for those scenarios?
Well, yeah, and we're those probabilities are coming from our empirical framework.
All right.
We're using data on all those dimensions you mentioned, Ken, right? We have demographic patterns of every country in the world. We have debt levels. We have inflation, GDP, stock market returns. They're all part of a living, breathing system, as well as those dimensions of technological change, right? New industries, automation, augmentation. They're all tariff rates, trade patterns between countries. Actually, in the industry, that is not typically done.
Mm-hmm.
All these forces are not part of a living, breathing or system. These trends are assumed to be held constant, which is why the Federal Reserve's forecast is straight, no change in the next several years. They assume some of these negative forces effectively will be offset by a little bit of AI. So it'll be like a seesaw. It'll just be like even.
Mm.
Which respectfully, in China, I see the same forecast from experts. Growth will be kind of even, demographics will be down, but productivity will go up just a little bit.
Mm-hmm.
What our diagnosis is that we cannot get that balance. It's either AI is going to way more than offset the stalling in demographics, the stalling in trade patterns around the world, the U.S. not trading as much with China, for example, right?
Mm-hmm.
That can be negative.
Mm-hmm.
Um, but it's in debt levels in the United States, China, in Europe, in Japan, and so there is no way. There's very low odds. We get what called the consensus or status quo scenario.
All right.
And so those two scenarios of what you're talking about, the one where AI overcomes this is
Mm-hmm.
by far the most likely.
All right.
It's the most likely scenario that has become our baseline scenario.
Mm-hmm.
And if we're wrong, it's because AI stalls and it only automates. And then we don't get those new industries. It's effectively the Elon Musk scenario. And then it starts to put pressure on the United States, in China, in Europe. And then those negative forces that you mentioned, poor demographics, high fiscal commitments, start to push interest rates up and the stock market down. And so, as investors, there is ways to navigate this world because it's going to change in some pretty significant ways. We think it's generally positive with disruption, but it is AI has not advanced sufficiently. It probably will, but right now, it hasn't quite got there. But the odds are rising that that's probably where we go.
All right. So then come back to the traditional finance area. I come back the the Vanguard being the leading ETF issuer in the U.S. market. And congratulations, just recently you overtake the BlackRock, become the #1 in your home market. And I think in your book, if I'm right, I think you mentioned about when we do the asset allocation, probably you can more use the active parts more than the passive instrument. So what is all about? What was your the ground? What's the ground you how are we
Yeah,
going to implement in the daily portfolio management?
sure. I would say, and this is my general recommendation or guidance for all investors, institutions, advisors, asset managers to consider is you have an ETF core portfolio, right? With broad exposures. Your firm is a great example, right? So you're invested in China, in Asia, in the United States. You have that broad exposure. We don't change that.
All right.
However, we also believe can be a role for active management for all investors if you keep the costs down, right? And that can take one of two forms. You can overweight some sectors or types of parts of the market, countries, sectors, industries, either to hedge risk or because you think they're going to benefit from technology. I talk a little bit about that in the book. That's the second half. That's the non-technology companies, right? And we are doing that for investors that are willing to take some active risk because we have to deviate from the market, right? And we're not going to get the timing exactly right for
Mm-hmm.
sure.
Mm-hmm.
That's one approach. The other approach is to if it's a big if, but I talk about in the book, if you can identify skilled managers that you and I believe can pinpoint the winners in some industries over the losers in an era of AI. In other words, not all the chip companies are going to do the same. Not all the data center companies or technology platforms or even the Mag 7. Not all of those companies are going to have the same return
Mm-hmm.
over the next 3, 5, 7 years, right?
Mm-hmm.
And so if you're willing, that's another way you can think about active management is to navigate some of these disruptions.
Mm-hmm.
But every it's a leap of belief that and this is always active management, right? Like you and I are trading with each other, and so as an investor, you have to think that you're going to do better in picking those companies than I will. And if I put my money with you and you're right, I can add some return
Mm-hmm.
to the portfolio. And so I talk a little bit about it in the book. It's generally not a core holding for most investors,
Mm-hmm.
but it depends on. I'm trying to navigate the disruption in the next 3 or 5 years. So me, Joe Davis, I am a risk tolerant investor. I want more risk, and so I'm willing to take some additional ETFs,
Right.
some that are active as part of my
Mm-hmm.
portfolio because I think there's
Okay.
some companies that can pick those up, as well as let's start moving into phase two, right? And the companies that may do well in the transition as AI
All right.
benefits more. But I'm not going to get the timing right. And so that's where I mentioned it's a little bit of active management because I could just own total stock, the world total stock market.
Mm-hmm.
Like Jack Bogle, our founder, would say start there. And I totally agree, start there. But there's ways that we as asset management companies can help advisors, we can help our clients by saying, if you're willing to take a little risk, there's ways that you can navigate this path a little bit better.
Mm-hmm. Okay. Then come back to the global assets allocation. I think you also mentioned in your book talking about on this topic. I think nowadays the global market is a mess, right? I mean, especially come firstly, you look at the FX world. The yen is all the way down, right?
Yeah.
Even the Japanese government intervene the market a while ago, but it seems not working, right? The yen
Yeah.
is still on the
Yes.
on the downtrend.
Yeah.
And I think I still remember last year, everybody talking about the dollar trend, right? The
Yeah.
dollar is all the way down, and everybody try to, invest away from the dollar assets. But this
Yeah.
year is completely changed, right? Dollar
Yes.
recently we see the rebound and across the whole emerging market, the loss of the currency from the India, especially on our part of the world, right? Asian
Yeah.
currencies falling apart. But meanwhile, I think the RMB is stood up, is
Yes.
very stable.
Yes.
I think is echoing about the Beijing's voice. They want to continue the RMB internalization, right? If you look at the March, what happened when the Middle East conflict and the whole emerging market currencies are falling all the way down, but RMB is very strong. And recently, on the onshore and offshore market, is just to break up the 3 years high.
Yeah.
So, what's your thought on the FX world on the currency side? The dollar trend is still the major theme people should focus on.
I think to get to it, those are great points. I'd say some of those trends, we actually, believe it or not, we actually saw coming in our framework. We don't get the month to month. It's all noisy, but the trend
Yeah.
has been clear, and our projections are it will continue that dynamic. More stability between the United States and the renminbi pair. And why? It's part of what's going on in global interest rates, which you're getting to, right? I mean, the Japanese yield, the bond yield,
Yeah.
JGB, is
Yeah.
going from close to zero to over 3 or 4%. We've had a rise and that is not a surprise. We started projecting those dynamics 4 years ago for the United States first, and then other countries over time. And that is this tension between AI that can keep interest rates from stop going further versus it doesn't do enough, and then the global debt levels will start to push interest rates up. More
Mm-hmm.
bond debt, lower bond prices, higher interest rates. The United States and China, different countries, different systems, the economic diagnosis is nearly identical
Mm-hmm.
because we have some of the same mega headwinds, demographics, some debt levels, but we also, by far, US and China has by far the most AI expertise, AI investment, leading AI companies. And so the dynamic actually suggests whether AI becomes much more transformative or not, the stability between the US and China from a currency and
Mm-hmm.
an interest rate level should actually be somewhat in balance. And so that
Yeah.
has not been but I think what is changing is the interest rate differentials, and it has happened between the US and Japan,
Mm-hmm.
between the US and Europe. And so that has a bearing in terms of the currency. It suggests that the US dollar will generally be in this environment with some volatility. Um, it also says that for many investors, and this is true in the United States and it's true in Asia, that the relative attractiveness of bonds has actually gone up because interest rates are higher than the rate of inflation. And you can
All
see
right.
that in Japan.
Yeah.
And so that's a generally a positive
Mm-hmm.
thing for investor. It's been one of the themes, investment themes that we've had for 4 years now.
Yeah.
That stock market could do well, but don't forget fixed income
Mm-hmm.
because you have higher real or after inflation interest rates. In fact, in the United States, you can get a 3% real return plus
Yeah. I saw
inflation.
that. Yeah.
Yeah, you can
And
get like,
most of,
yeah. I mean, what's the inflation rate? Roughly 3 or 4. 3% plus roughly 4% is a 7% return with not much risk. And
that's right.
so starting to say, listen, if our model portfolios want to be a little bit defensive here because the US stock market is looking frothy. The earnings dynamic is fine, but it
Yeah,
wants to push you into fixed income at the margin, particularly if Elon Musk is right with his diagnosis.
that's right. And come back to the U.S. economy. We be talking about the AI, can improve significantly in terms of the productivity. But what is the underlying U.S. economy right now looks like, especially we get into the second half and the middle election will come in, geopolitical concern. What is the underlying U.S. economy on the ground looks like?
Yeah, it's generally positive, but uneven.
All right.
The consumer, you
It's the
mentioned,
K-shaped, right? People talking
yeah,
about the shape in
K-shaped.
everywhere.
Yeah,
Yeah.
it's K-shaped, um, and historically, it's actually been K-shaped 70 to 80% of the time.
All right.
I'm not saying that that's desirable. I'm just saying that high net worth, wealthier consumers, United States, China, tend to drive half of consumer spending.
That's
At
right.
the end of the day, though, we are projecting, we have the Vanguard, because of our analysis, we have the highest expected economic growth forecast in
Mhm.
the asset management industry. We have GDP, real GDP approaching 3% next year.
All right.
And it's not because of consumer spending continuing to go up. It'll stay stable. It's because of the investment in artificial intelligence.
Hmm.
And that is the primary driver up and down in the business cycle. And it's where our analytics are very clear. And so it's generally positive. Um, the labor market is um, is stable. It's not weak. It's not very strong,
Hmm.
and we have a pretty good um, we have a we have a pretty good knowledge of what's going on in the U.S. labor market because we
Hmm.
have among the largest data sets,
All right.
even larger than the U.S. government,
Oh,
of job
really?
creation because we manage retirement systems. So we know every day how many people have been hired
All
because
right.
when you get hired, you get a new retirement plan. So we can
That's right.
see the number of jobs being created every day, sometimes before it's reported by U.S. officials.
So from your perspective, the U.S. job market is still quite healthy.
It's okay.
It's okay.
It's stable. Job
All right.
growth has come down,
Yeah.
but we also have immigration controls. So
Okay.
part of that has been a lack of supply. The unemployment rate is stable, and so demand and supply have come down at the same time. It is not getting worse.
All right.
Some worry, oh, AI is starting to automate jobs. We can only find that in one occupation, and that is software, computer programming, technology development. Younger workers, they're finding jobs at the same rate as the past 4 years. So it hasn't gotten worse. It's not really strong like during COVID, but it is not getting worse. And we know this from our own data. We have millions of records.
Hmm.
And so I would say it's a little bit soft here and there. Parts of
All right.
IT, a little bit of finance, there's some weak spots, but generally speaking, we have an unemployment rate that's 4.5%. So I'd say it's stable.
All right.
It's not really strong, but it's not really weak either.
Okay. So on the interest rate side, So people expected, the next month, which is the market right now is whisper maybe we have the more chance to give a hike for the Fed rate. What's
Yeah.
your take?
I think it's unlikely that the Federal
All right.
Reserve will raise rates. Um, I'm glad that they're talking about it. As you well know, you've talked about it yourself, inflation has been above the 2% level that the Federal Reserve would want for a
Mhm.
long time. It's 4 or 5 years. Inflation has been higher than 2%.
That's right.
And and we have been urging policymakers not to cut rates over the past several years, given what we said. We thought, and I think we're seeing this. We thought
Mhm.
the neutral level of interest rates was higher than the Federal Reserve thought for a number of reasons. And so inflation could be could be sticky or could be higher than expected if you would keep rates low.
Mhm.
And so I'm glad to see the Federal Reserve at least talking about it. I think more likely than not, we will see the Federal Reserve talk tough on inflation. But I don't think it's likely that they'll raise rates significantly. I mean, maybe one hike, but and again, this is coming from a firm and my group that we have the highest economic growth projections
Yeah. All right.
in the industry. So you would think we would be saying higher interest rates. The Fed should cut rates, but it's
Okay.
because of productivity is going up and AI investment, not because um, it's all demand and consumers are spending. The economy is overheating. That is not our diagnosis.
All
And
right.
so it's very similar to the mid to late 1990s, which, by the way, what I think Chairman Warsh, I think that's his sort of his view of the world.
All right.
Um, and so our framework, I think, will become more prominent in the Federal Reserve projections because we are taking into account these innovation rates moving
All right.
that some central bank forecasts do not do.
All right. I think Wash, as far as I know, is also the believer that AI is going to significantly change the
Yes.
business model, economy model, right? Okay.
Well,
So
he bel
the
he believes that. Yes, he does. He does. That's why he has these task force. One of them looking at how the Federal Reserve may think about these issues,
Mhm,
and does
mhm.
it change their own forecast? We believe the Federal Reserve, respectfully, their forecast will start to look like ours in the baseline. But that's an opinion I have. But I think they will start to take into account those same dimensions, those same interactions that we are doing in our framework that I talk about in the book. I mean, I'm highly confident that's what they will do.
Okay. I think the final question from me is, giving back to your book, it's really a good book. I think if you want to summarize one sentence to give our audience or Chinese investor, what's the message you're going to send to them?
I think this is an easy way to understand all these big picture forces in a digestible way. So you don't have to be an economist to read this book.
All right, that's good. Okay, so thanks for your time. It's really good to catch up here.
No, I want to thank you for your time and your questions, and I'm always here to take more questions or to talk, to clients or colleagues. It's an honor to be on the call.
Okay, okay, we will. I'll stay in touch. Okay, thank you.
Thank you so much. Cheers. Thank you.
Okay, bye bye.
Bye bye.